If you stood here in Dubai Hills Estate 10 years ago, all you would have seen was sand. So people who lacked this vision, they saw the desert, but people who understood Emaar's master plan saw the future Beverly Hills of Dubai that it is today. But today we're talking about the newest addition to Emaar's master plan portfolio. It is a 55 billion master plan and Emaar's newest land bank. It's the long-awaited master plan called the Heights Country Club and Wellness. And I want to show you exactly where that true value is hidden before the rest of the market catches up. To understand the true value though, it's necessary to take a step back and view the entire landscape. So over the past 20 years, slowly Dubai has always moved south. It first moved to the creek, it moved to downtown, it moved to the marina, but the bottom line is it's moving south. Why? The Urban Master Plan of 2014. And the government is not simply constructing an airport there, it is creating an airtropolis. So we're talking about an economic zone that is meant for 260 million passengers, 12 million tons of cargo annually. Let's consider the future profile of the tenant or buyer who buys from you. Who lives here in 2029? It is not the pilots, it's the tech CEOs operating out of Expo City, it's the logistics tycoon running empires in Dubai South. And these people cannot afford a 30-minute commute from the marina every day. They need to have their luxury compound 5 minutes from their headquarters. So moreover, we need to see that investors that invested into Emaar villa master communities have always fared excellently. So villa communities like Emirates Living are up 450% to date. Dubai Hills Estate is up 203% with the Sidra Villas, and Arabian Ranches 1 with the Savannah Villas made 750% capital appreciation on average. So this is just to show you what's possible with Emaar villa investments. I just mentioned you the price increases. That means it's the demand side of things. So they're very requested, otherwise they would not appreciate this much. Now let's look also at the general supply that is hitting the market. I already mentioned this in depth in my video about the top 4 villa communities in detail. So for a full analysis on the villa segment, please have a look over there. However, the baseline is that the total supply of villas in the next 3 years' time is only 6% of the total market volume. So that means currently we're facing a huge scarcity in the villa segment since the demand is already there today. So this means investing in a villa in 2026 is probably one of the smartest financial decisions that you can make. And how to do it is the best to use a developer with the best track record like Emaar. Welcome to the Country Club, the Heights Country Club and Wellness. What a beautiful day to explore this new master community. And we just drove down Emirates Road and arrived here at the Heights, where it's going to be in the future. To be honest, even Dubai Hills Estate looked very much like this, like a pit of sand, but nowadays it's the Beverly Hills of Dubai. So we're presently standing exactly 10 minutes away from the entrance of Al Maktoum International Airport. To the tourist, this is the edge of the map, but to the investor, this is the center of the Golden Triangle. So it's situated here between the future world's largest airport on one hand and the Expo City legacy side. When you just buy here, you're not just buying a villa. In a sense, you're entering a futures contract on the infrastructure which will drive 20 to 50-year-old economy of Dubai. History teaches you that real estate values do not simply follow luxury goods or curves, they follow connectivity. And that brings me to the new Al Fay Road initiative of the RTA, which is 1.5 billion dirhams. And this is a brand new road initiative that will connect the Heights directly with Al Khail Road. And it will be such a great connectivity that you can reach Dubai Hills Estate in 10 minutes, downtown in 50 minutes, right from here. It will be ready by the same time that the Heights will be handing over. So we looked at the extension of Al Fay Road, which will make the connectivity a breeze, but we're also very well located in general here, and that is a hidden variable in Dubai real estate that needs to be put actually on a spreadsheet, and that is the traffic. If you live in JVC or near Hesse Street today, you're losing an hour of your life every day in a traffic gridlock. Time is the one asset that HNIs cannot buy back. We are right now on the E611, the Emirates Road, and it's a massive free-flowing artery that connects in Abu Dhabi in 45 minutes, the IFC in 30 minutes. So you're bypassing the entire city center bottleneck. For a family living, there's hours of extra family time. You're buying basically the freedom of movement. So when the city density increases in 5 years, the access to Emirates Road will be the ultimate luxury. Now, let's look at the strong suit of Emaar. Your question might be, why Emaar? Why not buy in Dubai South or any other development that is in the vicinity where the price per square foot that might be slightly lower? And that's a valid question, but the answer is 2 words: exit, liquidity. So when the market changes and it always does, secondary buyers will flock to quality. They're looking for the Emaar brand, and they know that the community management, the landscaping, and the maintenance will be world-class quality. You might save 5 to 10% for buying from a smaller developer today. However, you stand to lose 20% of your resale speed later on. And we pay the Emaar premium today to provide ourselves with a liquidity asset tomorrow. So moving on to the hard numbers, the sizes and the prices. This is where the Heights completely separates itself from the competition. In most new master communities, the standard 3-bedroom townhouses and also villas, they barely break 2,500 square feet. So it feels tight, but it feels like an entry-level product. So here at the Heights, the scale is different. The 3-bedroom units in clusters like Salva or Serro are clocking in at an average of 3,403 square feet. Let me repeat that. It's 3,500 square feet almost for a 3-bedroom unit. And that practically is a 5-bedroom size in some other communities like the Lagoons. So you're getting a massive open layouts, and that compete with the standalone villas in similar communities like Lagaf, but at a fraction of the price. So 4 bedrooms are even 4,500 square feet, and 5 bedrooms are around 5,700 square feet. Those are great villas with amazing layouts, and 5 bedrooms even have G+2, that means 2 stories above the ground floor with an inbuilt lift. Now that is pure luxury. And speaking of price, let's look at the benchmark. Just next door, we saw 3 bedrooms launch for 5.5 million at Grand Polo. In no time, in the next launch, they escalated to 6.5 million dirhams. That is a 20% appreciation in just a few months. We're launching at approximately 6.5 million dirhams in the Heights, but in view of the size differential, the cost per square foot is arguably the most attractive value play in the luxury segment. But in real estate, the value is always relative, so the Heights cannot be assessed or judged just in isolation. So you have to judge it against the other villa communities of this corridor. Number 1, Lagaf. Number 2, Damac Lagoons, which is fair enough, mostly townhouses. Lagaf, Damac Lagoons, and the Heights. They live geographically minutes apart, especially with the Al Fay extension. But financially, they're worlds apart. For instance, Lagaf, this is a phenomenal community, and Majid Al Futtaim did an extraordinary job, but let's look at the entry price today. The secondary market prices for a comparable 4-bedroom villa in communities like Aura or Harmony are currently reaching 8 to 9 million. Harmony is even reaching higher than that, 11, 12 million. For instance, a 4-bedroom twin villa in Aura is 3,400 square feet. In these communities, the primary growth phase is over, so buyers are entering at the peak price of the curve, and that usually is what end users want to live there. So now consider the Heights. We're launching at similar specifications, including larger plot sizes and built-up area at a price point of 6.5 million. Notably, the Heights, our 3-bedroom units, offer the same square footage as a 4-bedroom twin villa in Aura. So this creates a substantial 2.5 million dirham spread, a significant price gap that acts as your equity cushion. As the essential airport infrastructure over there, the development is progressing. This price disparity is projected to close up. So essentially, you're acquiring Lagaf quality at what were effectively 2021 price levels. And now the skeptics will say, what about Damac Lagoons or Damac Islands too? It's a lot cheaper. And they're right, they're cheaper. However, they're mainly townhouses, and you can find units there for less. But you have to look at density. The profit in real estate isn't just the bricks, it's the land that we're standing on. Lower price communities squeeze more units into smaller clusters, and at the Heights by Emaar, this is a deciding difference at the higher percentage that is left to open space. So lower density means higher scarcity, and in a luxury market, scarcity is the only thing that protects your price when the market slows down. But it's only half the story. So now we're back in the office, and I want to talk a little bit more about the term capital efficiency. So since you're purchasing a villa, you're not writing a check of the entire 6 million dirhams today. So you're on a construction-linked payment plan. That means you pay 10% to book, and then small installments of about 10% roughly every 6 months for the project to rise out of the sand. So why does that matter? It gives you a certain type of leverage, right? You're in control of a huge asset, using only a small amount of equity at a time. So if in 2 years' time, the value of the property increases by a mere 10%, that means your return on the actual cash that you invested is nearly double that. So that's the secret of how smart money builds wealth in Dubai off-plan markets, and you use Emaar's balance sheet to compound your own returns. So this is of course no news that the payment plans of Emaar make sense, but it's important to mention this to newcomers to the Dubai real estate market. I promised you a forensic audit, so let's cut through the noise and actually look strictly at the math. So I've run the numbers specifically for the heights using the 80-20 payment plan structure. The scenario A is you secure a unit for 6.5 million dirhams, and the plan is 80% during construction and the final 20% is due on completion. But here is where the strategy gets interesting. Say we're in about 3 years into the payment plan and you haven't paid the full price yet. We're sitting roughly at about 60 to 70% paid in raw cash deployment, maybe 4 to 5 million dirhams. Now, let's assume the market is quite boring, no big boom is happening, and let's assume the worst case scenario. Your villa just steadily appreciated, went at a modest pace, and the property value treads from 6.5 million to around 7.5 million. Now, end users as well as investors will be interested in a villa at this point in time. So you sell the contract to them, and you walk away with a profit of 1 million dirhams. But remember, you did not risk 6.5 million to make that million. You risked only about 4 million cash that you had in the game. So this makes your return on cash invested figure shoot up by 25%. So what you're doing essentially is using someone else's balance sheet to boost your returns and giving the keys to someone else when it's time to pay the bill. So this is what we call asymmetric risk. So if the market goes flat, you own a prime asset near the world's largest airport. And if the market runs, your leveraged returns hit 40, 50, 60, 70, even 80%. We saw this already in the appreciation of the other master communities before. Now, I don't know about you, but I'd rather have my money sitting here than in a bank account losing to inflation, which is insane at the moment. And that is just the capital appreciation. So we even haven't touched the rental yields yet, which is projected to sit between 7 to 8%. So let's get forensic on the product itself as well. So Emaar has introduced different clusters. One is called Salva, one is called Serro, and one is called Serro 2. So don't simply pick one of them just by the name. They're fundamentally different assets. So Salva is based upon the concept of flow, light LED interiors, massive floor-to-ceiling windows, and it sounds modern, airy, and almost like a gallery. So Serro is about the root, and it's a warm beiges, tactical stone, and earthy textures. So it feels more grounded, so more solid. Both clusters use combination of type A, B, and C facades to prevent the cookie cutter phenomenon, which we see in some communities in Dubai. So we've talked about the statistic. Next, let's bring up the rentability. An investor buys a house and a renter rents a lifestyle. So what makes the heights rentable? It's the soft infrastructure. We're not just talking about a gym. We're looking at schools, retail, clinics as part of a whole master plan. So a high net worth expat family moving to Dubai in 2029 and 2030 will select this location because their kids can ride their bikes to school without ever having to cross and encounter a main road, which is also something that I did with my own villa. Now this safety comes in obviously baked with a premium of 15 to 20% over other individual villas in other communities where they don't have schools. Now let's talk about the wellness aspect of this community. And the brochures even show you yoga parks, lakes, green belts, and everywhere amenities at your doorsteps. Now from an investment point of view, I care about density. Wellness is just a marketing code for distance between your neighbors and special amenities, of course, like yoga parks, lakes, and so on and so forth. So the basic plan has larger gaps between clusters than any other Emaar community this year. And that space, that emptiness, is what protects your resale value in the future. So as I mentioned at the start, if you analyze the past data on Emaar Phase 1 investors, they tend to have the highest returns. So for early adopters, the properties from Arabian Ranches to Dubai Hills have seen excellent capital growth between 100 to 700%. So here's the verdict. If you're looking for quick cash flow or a flip within 6 months, this is not the right asset for you. You should actually look elsewhere at this point. But if you're looking to park capital in a legacy asset that will mature alongside with the world's largest airport, this is probably the safest aggressive play in the market today. I have personally already identified specific shortlist of prime units with the best layouts, the best park access, and also the best sun position in the afternoons. I do not share this list publicly on YouTube, so if you want to review the shortlisted and structure a portfolio here, do not wait for the next price hike. Use the link in the description below and book a private consultation with me. You can buy a unit from a brochure, or you can buy a strategy from the ground up. I'm Sebastian Boll, and I'll see you in the next audit.